I have passed. Oh,
Sorry. No,
no, you're fine. You're fine.
I had a
I have
recording.
gotten my.
You gotta share it to the people. But go ahead.
Sure. No worries, no worries. I have gotten my. I have passed the uniform residential mortgage license test that allows me to get my license in any other state that I choose as well. I am definitely a very experienced loan officer, I would say. I say that laughingly because, as Tyron will probably tell you, in our industry, every day is different, and you're always going to run into new situations, different situations, because our industry is so fluid.
Yeah.
Because society changes, things that are important to people changes. That you have baby boomers, you have a new generation, just technology changes things. So we have to be very fluid in that regard as well. So in times like that, it helps to have somebody who's pretty flexible. So getting back to who I am and what I do, again, I am licensed in 15 states. I do refinances, new home purchases. I work with investors or investment properties. I work with property managers as well. Pretty much all things real estate I have my into.
Awesome. So
Yes, ma'am.
Jeremy, we all know that right now this market is booming right now.
Yes,
It's what we
ma'am.
call a seller's market, so to speak. More or less, we're having a lot of first time home buyers in this season.
Mhm. Yep.
In addition to being a seller's market, there is also a great opportunity for buyers. Would you
Yep.
elaborate on what you see from day to day as far as your buyers? Are you getting more buyers who are less qualified or more qualified?
That's a great question. Honestly, in today's society, they have done a really good job of making things more affordable for borrowers because of the different situations that we find ourselves in nowadays. And that's a very good question, even though some people may think that they're not qualified, because I do find a lot of people have that notion or that predetermined thought process that they aren't approved because of their income might not be W-2, right? Or they think they may not make the amount of money that they need, when in all actuality, there are programs for everybody now. Just because of the way the society has changed, and you have people making money off of YouTube, right? You have making money off of TikTok. You have people, in services industries that are 100% commission now. People that live off of their tips, right? So there are so many different ways that people have started to generate money. There are more people that are more self-employed, right? More people are starting own businesses. So because of that, they have taken those things into account, and thus they have made programs available for, I guess, every single one of those buckets. So I am finding nowadays that everybody falls into one of those buckets, right? My job is to find out, hey, what are your goals? What are you looking to get done? Because everybody's in a different stage in their life, right? Whether it's a first-time home buyer or somebody who's downsizing because their kids have moved out, right? So there is something for everybody. And I am finding that nowadays it's actually a little bit easier to get people qualified than it has been in the past.
Okay, with that being said, what are some of the qualifications or the requirements rather that is needed for someone who's self-employed?
Great question. So that and that's a loaded question, but generally speaking, when you are self-employed, they are wanting to see tax returns for the past 2 years. Depending on the type of loan that you're going through, there are mainly 4 types: conventional, FHA, USDA, VA. Generally speaking, it's 2 years they want to see your tax returns. What they're looking for on your tax returns is your Schedule C. Or if you file an S Corp, then they'll look for your corporate tax returns, right? But they're looking for your adjusted gross income. A lot of people will show X amount as their gross income, and then after deductions and things of that nature, they will write off X amount, and they'll say, hey, this is my actual income after taxes and things of that nature, which is good for them because it helps them reduce their tax liability. But we as the lender, we have to use that adjusted gross income, that second number that they write off, which is where the rubber meets the road for a lot of self-employed borrowers. A lot of self-employed borrowers don't know that. And when they try to get applied for a loan, they are now hit with the task of qualifying for much less than they thought they would be able to. But that's what you're looking for. 2 years of tax returns. A lot of programs now will let you get by with 1 year of tax returns. And then also if you are corporate, if you have an S corp, again, you're looking for your 1120s, your corporation tax return, excuse me, for the last 2 years.
Okay. And I know we went into a little bit about the different type of loan categories.
Yes, ma'am.
Let's elaborate a little bit about the categories of residential first mortgage loans. Can you give us the different type of loans they are? I know you mentioned it before, but let's dive into it.
Say that. Can you ask that question again? I'm sorry.
The different categories of residential first mortgage loans.
Oh, sure. Yes. So you have FHA, you have conventional, VA, and you have USDA. So those are the 4 types. Everybody's going to fall into one of those. Those are what we call conforming loan types, meaning they conform to essentially Fannie Mae, Freddie Mac. If you guys have ever heard those names before, those are investors. They are the ones who are fronting the money for people to purchase these properties. So essentially, they want servicers to service that money on those loans on their behalf. So 4 types, again, FHA, conventional, those are 2 standard types. Your specialized types are VA and USDA, meaning you have to do something extra for those. VA stands for Veteran Affairs, right? So you have to be a veteran of the United States military or active duty, Coast Guard, reserves, all of that, anything that has to do with military. If you have served, you are eligible for a VA loan. VA loans are very, very good. They come with no down payment. So a lot of times you will see 100% financing with VA loans. And the best thing about them, they have no PMI, even at 100% financing, which makes your payment significantly lower than what it would be on let's say, a conventional loan.
Right.
USDA is the rural housing. So those houses that are kind of out there in our area, we're looking at things like Clover, South Carolina, or Kannapolis, or I know Kannapolis is growing now, but those areas that may have larger lot sizes, right? They are considered USDA or rural development. Those also come with a no down payment loan. So a lot of people who are fine with a little bit of drive, if you don't work in the city, you work remote, like the easy living, then yes, those loans do come with 100%. And I will actually give you the website. There's a website where you can go and put in a zip code or put in an area, and it will show you the entire map of what homes are in eligible USDA territories. Very useful for home buyers, because if you can pinpoint an area of where you want to live, and it's in a USDA eligible area, it's a very good chance that you can get a USDA loan that's not having any down payment, making your home buying process a lot more affordable for you.
Yeah. So really quick, in regards to the VA loans, Jeremy, who qualifies for a VA loan? Like who are the people that can qualify for a VA loan besides the actual veteran?
Well, you have to be a veteran to qualify for a VA loan. Like those are anybody. If you are a veteran, you qualify for a VA loan based off of that. There are still other criteria. Like I believe the minimum FICO score is a 580. Yeah. They're different at other places, right? So I think some places are 620. We go as low as 580 for VA loans, and then your debt to income ratio is 60%, whereas it's 45. I know that's kind of getting a little specific here, but does that answer your question?
Well, I think for people who may be like a relative, maybe a wife, maybe, the spouse, the
Mhm,
children, do
mhm.
they also qualify for that VA loan if they are relatives of a veteran?
That's a great question. And the answer is no, unfortunately. Although they do receive, those rights, right? So I believe with USAA and Navy Federal, you can get an account with them, and sometimes they will allow you to um, get a loan under maybe like your father's VA assistance or something like that. It's not necessarily using the veterans VA eligibility. It's a loan that Navy Federal may have in-house that's called that they use to help service their clients. But that's not a nationwide program. That's with that bank specifically. But generally speaking, only the veteran will qualify for a VA loan. It does not extend to family members and children, although their rights do. If they are on the loan, if there is a wife that is on the loan, she does have survivorship. Children, they do have survivorship if they're left on title and things of that nature. Those loans and those rights do transfer over. So in the case that the veteran is deceased, they will be able to still obtain the house, keep the house in their name, all of that good stuff.
Cool, cool, cool. All right, well, let's move over to the FHA loan. What is the credit requirement for an FHA loan?
Great question. So when you're talking about requirements, they do differ from lender to lender. All right, it's not always just set. The minimum FICO score that we require is 580. Most places will be at that 580 or 620 mark for your FHA clients. And when we're talking about FICO scores, we are talking about a tri-merge. And so what they do is they will use all three of your scores: TransUnion, Experian, and Equifax. And to be fair to everyone, they will not take the highest score and they will not take the lowest score. Whatever score is in the middle, that's the score that they're going to use. And that's the score that we're referring to that needs to be over 580. The FHA, however, does have I guess an exception policy. If your credit score is below 580, and you do have still an approved loan, they look at other things, what we call compensating factors. Like if you have strong assets, or if you have very good payment history, if you have a low debt to income ratio, things that strengthen your loan profile, they would even consider credit scores lower than that.
Okay.
But generally speaking, 580 is what you're looking at.
Okay. So with the 580 credit score, are you seeing more buyers or more borrowers, I would say? Are you seeing more borrowers with 580, and possibly are you seeing more single people or more married people coming to you with 580 or less credit scores?
Good question. Yeah, so really, that's a good question too. It varies, honestly. I will see, I mean, just because of the work that I do and the spectrum that the people that I work with, I see borrowers at 500 credit scores. And I still work with those people because we have credit simulators, things that we can do to help them reach that target goal so that we can do a loan for them in the future. And then I see my, 700 borrowers, both single and married. It always works out that, in a married couple, I guess one person who carries all of the finances in their name may have a lower credit score than the other spouse who doesn't. I see that pretty often. But, generally speaking, it really just comes down to that individual and their finances, right? The credit score is going to be a direct reflection of, how you manage your money and how you pay your bills, right? So I have seen young people on both sides, and I have seen older, I should say, people that make hundreds of thousands of dollars that still have, a 500 credit score because they can't manage their money. So it's it really just comes down to the individual. I know it didn't really answer your question, but hopefully that.
That was actually a really good response. So what do you guys normally, when you have an FHA borrower, are you guys normally, educating your buyers to, what they will need when they get towards closing? Like what's your amount of down payment you would need, how much you would need in closing costs? For someone with, let's just say, a 580 credit score, maybe their debt to income ratio is low. What would you recommend for them as far as letting them know what they need to bring to closing? How much in closing costs, how much they need in down payment? What would you recommend for someone in that credit range? Maybe they make, let's just say they make about 30 to 40,000 a year.
Okay, that's a great question. And the good thing about it is they don't actually, regardless of your credit score, let me back up and say this. A loan approval is based upon three things, right? It's based upon number one, credit history and credit score. Number two, what we call a debt to income ratio. And number three, what we call a loan to value or a down payment. Right. So those three things are what it's based upon. The good news for most people is that credit score is only one of the three pieces that it takes to get a loan done. So even if your credit score is not the best, right? If you're at 580, and I've even had this people at 581, and they're like, "Oh my gosh, I made it!" Right? As long as you're over that 580, and we can get a loan done for you, that is not an indication of. That does not play a factor into the other pieces of the loan process that is approved upon, if that makes sense. Sorry, I stumbled a little bit. What I'm trying to say is you can have a 580 credit score. That's not going to make your loan more expensive than somebody who has a 750 credit score. Those two people are still going to be bringing the same amount of money to closing, right? If that makes sense.
Yeah.
That your credit score is going to affect is going to be the interest rate, right? So that person with the 580, they may have a slightly higher mortgage payment on a monthly basis than the person with the 780. But as far as closing costs, your down payment, things of that nature, they're going to be the same. So FHA, to answer your question, on an FHA loan, the minimum down payment is 3.5% of whatever the sales price is, whatever the purchase price of the house, 3.5% is the required down payment for an FHA loan. Your closing costs are going to vary depending upon the house, right? Because the closing costs include your escrow for taxes and homeowners insurance. And of course, as we know, taxes are going to be different on every house. And homeowners insurance is actually left up to the homeowner, the borrower. You guys get to choose who you want to use for insurance. So those two pieces are going to be different on every home, as well as the attorney, things of that nature. I generally like to give people, and depending upon the loan amount, somewhere between $3,500 and maybe $5,500 for closing costs. So I kind of just ballpark it depending upon what area they may be purchasing in, what loan amount range we may be in. If the borrowers have a property in mind, say, "Hey, Jeremy, my real estate agent is taking me out to see these two houses this weekend." My borrowers will send me that address. I'll be able to look up the taxes, kind of get an idea for insurance, and say, "Hey, this is kind of the payment. This is what you're looking at as far as your closing costs," things like that. I mean, I'll be able to ballpark it a little bit more if I have a house in mind. But 3.5% of the purchase price for the down payment, and then add maybe 35 to 5,000 for closing costs.
Got it. Awesome.
Yeah.
Well, I know that we spoke about FHA loans. Let's get into conventional loans. Give us a little.
Before we go there, I wanted to add one more thing that a lot of people don't know. And you may be getting into this later on in the call, but before I forget about it, there are a lot of ways to come up with those funds, right? Are many down payment assistance programs, especially for first-time home buyers. Of incentives, so you can get those funds from down payment. Those funds can come from a gift from a family, a member or a relative, or even a friend. Yeah, they can come from your employer. They can come from 401k funds, IRAs. They can come from, if your DTI supports it. I've even seen people get a loan for it. So that those funds can come from a multiple variety of different ways. The seller can help pay for closing costs. The lender can give a lender credit to help pay for closing costs. So I know that figure may sound overwhelming at first, but after the parties start to chop down and contribute, it can really make it a lot more affordable for borrowers to get homes. And a lot of people are using those resources. I've seen borrowers come to closing with a couple $100. It is very doable and it is possible. So don't let those numbers scare you. So.
And just to piggyback off of those down payment assistance programs that you mentioned, do those loans that, say if you just get a loan for your down payment, do they include that in your mortgage? How do you repay that? And like, do they just include it in your mortgage on a monthly basis moving forward? How does that work when it comes to repayment of those down payment programs?
Great question. So a lot of depending upon the down payment assistance program you go with, that is going to determine the repayability, right? Every county in North Carolina has their own. I feel like, I can't, maybe not every single county, but for example, here in North Carolina, you have the North Carolina Housing Finance Association that covers the whole state of North Carolina. And then here in Charlotte, you have House Charlotte, just covers the city of Charlotte and Mecklenburg County. You have Concord has their own down payment assistance, right? Fort Mill, South Carolina has their own down payment assistance. So and a lot of some companies will let you piggyback, right? Some will let you use NCHFA and House Charlotte and use both down payment assistance programs for one home. So, but each of them are going to be a little bit different. All of them pretty much work off of what they call a forgiveness period, meaning that amount that they lend you or give you for your assistance will have a required time period in which that mortgage is left out there before it is forgiven. So, for example, let's say you buy $100,000 house. And your down payment assistance, you got $5,000 in your down payment assistance. They will give the loan for the first mortgage. They will have a second mortgage for that $5,000 in down payment assistance. They call it a silent second. The reason it's silent is because you will not be making a payment towards that money, right? You don't make any payments. It's not included in your mortgage payment, or your mortgage payment isn't higher because of it or anything like that. It's just sitting out there for whatever that forgiveness period is, whether it's 3 years, 5 years, 10 years, 15 years. Once that forgiveness period hits, that second mortgage will fall off and will be completely forgiven. If the property is either refinanced or sold before that forgiveness period is met, then that loan now becomes repayable. And they will either roll that into your loan amount and it will increase your payment slightly, or they will require that it comes out of your loan proceeds. That pay it out, that you pay it for. Like, for example, if you sell your house, say you sell your house and you make $25,000, they will take the $5,000 from the 20 and give you the remaining. Does that make sense?
And it's a lot of
if you refinance it, they will just roll it onto your mortgage, and that may cause a slight increase in your payment.
Okay, good to know.
But you want to be very aware of what the forgiveness period is, because some are 5, which is not a big deal. Some are 15, which is a much longer period of time to be stuck in your house. But to each his own. For somebody who's, hey, this is my last house, this is my retirement house, right? They may not care about that 15-year period. Somebody, first-time home buyer, this is my first house, 3 to 5 years. That's what they're looking for. They make these options available because the big motto in our industry is to each his own. Yes.
So let me ask you this. There's this clause that they say, or not clause, but this term that they use called know before you owe. What is that reference? What do you think that means? Know before you owe. Have you ever heard of that?
Know before you, oh yeah, they're essentially just saying you want to know what your loan program is. You want to know what you're getting yourself into. Prior to 2010, 2009, before the market collapsed. You hear the stories about what kind of things were going on. The people using whiteout on the paper, or people doing back office deals and charging us money, calling the appraiser and saying, "Hey, Mr. Appraiser, I need the house to come in at X amount." Like those kind of things. When borrowers are not aware of adjustable rate mortgages or things of that nature, those little nuances of their loans that may come back to bite them in the future, right? A lot of people got trapped, and that's why there's such a big stigma against adjustable rate mortgages now, because people are so afraid of them because of what they heard back then when they were abused, right? But adjustable rate mortgages are very good programs for the right borrower. Right. I would say that's what that means. Know before you owe. You want to have a loan officer or a company that will explain to you your loan program. Nowadays, they do make a lot more efforts to make things more transparent. As far as like sending loan estimates out to the borrowers within 3 days of any change, sending out the closing disclosure that has all the final numbers on it before closing, so that you don't get to the closing table and you're like, "Oh my goodness, what is this?" They try to do a lot of things like that as far as information to help people understand the type of loan that they're getting and what it means to have this specific type of mortgage, because it is different. Like I said, to each his own. There are a lot of programs out there. We want to make sure that we're putting people in the right ones.
What would you say, really quick, Jeremy, what would you say is the current APR rate for a FHA loan?
That's a very difficult question, because it's how can I put this? That's going to be different for everybody, and I know that's the question that's probably the answer that you're expecting me to say, but it really is true, right? The way that they come up with rates, it's different, right? So you have on the scale of credit scores, right? They range from 350 to 850, right? 300 to 850, right? And they go in buckets, right? There's like a 580 to 620, 621 to 640, 641 to 660, depending upon what bucket your credit score falls in. The pricing is going to be a little bit different. So that's why I say, whereas that 580 person might have a 3.75%, that 780 person might have a 3%. It's a very big difference in rates, but that is a very real picture of what things could look like between that drastic difference in credit scores. But generally speaking, rates are very good. Whenever you see an advertisement on TV and they say, "Hey, the rate is X amount," right? Projecting a borrower with a 760 credit score and 20% down. Right. And that's how a lot of people get trapped in there. They call the bank, they're like, "Hey, I saw 2.875 on the TV." You don't have 20% down in a 780 credit score. That's not necessarily the score that you get. May get, something close to that, right? But it's going to be that ballpark. So I would say, generally speaking, you're probably on an FHA mortgage, you may be looking between 3% and 3.25, maybe 3.5%, in that range, depending upon your varied credit score. But rates are very good. The rates are very low right now. It's still a very good opportunity.
Yeah. How long do you think that they're going to stay at this level that they're at? Because everyone's like, "Oh, well, if you purchase now, you can get a locked-in rate," whereby they're saying, "Oh, going into 2022, we're going to have that same rate, or it may go up." Where do you think it's at as far as ending the fourth quarter, going into the first quarter for the next year?
Sure. So my personal opinion, and the reason I say that is because nobody knows. The feds are always, changing things. They're the ones that control the rates. If anybody wants to follow what rates do, I have an email that I can send out that kind of gives an idea of what's going on. My mortgage, I think it's called mymortgagereport.com is also a good resource for it. The 10-year treasury bond is what the rates are based off of. So if you look at stocks, if you look at the market, 10-year treasury bonds, that's how rates are going to be fluctuating. But I would say it's a good question.
I mean, everyone's like, it's a good time to buy, the mortgage rate's gonna go up next year. I'm telling my buyers, I'm like, hey, listen, you want to lock in now?
Honestly, I would. I mean, based off of the information that I see and that I read, mortgage rates are probably going to be, they're projected by the end of next year, they're going to be in the 4% range. Okay. And we've already seen rates go up. Yeah. As we know, rates were at 2.875, 2.75, even a few months ago. We do see rates get higher towards the end of the year, you know what I mean? Because the market traditionally slows down in the November, December month, even though that's not what we're seeing this year. We're buying. Yeah. People are buying like crazy, which they should be, right? Because you got to understand, these are historic lows. Like interest rates have never been this low. And they probably, I'll be honest with you, probably won't get this low again anytime soon. It's going to take the market a long time for it to cycle around. Everything is cyclical. So not saying it won't be this low again, but it probably will be a while before it is this low again. Let's put it that way.
That's important.
Yes,
all right,
ma'am.
well, let's get a little bit into conventional loans. I know we spoke a lot about the FHA loan. Let's get into conventional loans and who qualifies for it, and what is the required credit score for a conventional loan?
Okay, great question. So conventional loans is generally one of the biggest buckets, right? FHA and conventional. If you don't go with VA or USDA, FHA and conventional are your only two options. So like everybody is going to fall in one of those two buckets. But most people might fall in both of them, right? But you're going to fall in either one or the other. Either FHA is going to be really, really good for you because conventional is not a good option, or conventional is going to be a really good option for you because FHA doesn't make sense. That's kind of how we play it in that sense. The minimum FICO score for conventional is 620. So it is higher than your 580 that's required for an FHA loan. And it's the debt to income ratio is a little bit lower on conventional than it is for FHA as well. But still a very good loan program for the right type of person, for the right buyer, right? Your conventional loan, you're looking for those buyers who have the higher credit scores. You're 680 and above, conventional is going to be a very good option for you, pretty good option for you. That's kind of where your interest rate and your PMI start to become a little less expensive for you. Anything under 680, FHA is probably a really good option, just because the interest rate and the PMI structure on FHA it's not as rigid as conventional. That's where that comes in.
For those who don't know, PMI is private mortgage insurance. I'm sorry, go ahead.
Yes. I'm sorry. No. Do you want me to take some time to kind of?
No. It's fine. You've been doing so good, but I know some people don't know. I just threw that out there, but you're doing great. Go ahead. I'm sorry.
Sure. Yeah, no worries. Yeah, but no, that's really it with conventional. I mean, a lot first-time home buyers, they have 3% is the minimum down payment on a conventional first-time home buyer program, rather than 5%. If you are going through a conventional purchase, you already have a home, it's your second home you're buying, 5% is your minimum down payment. For some home buyers, it's 3%. So it's a little bit less than the 3.5% on the FHA loan. Right. But again, the PMI structure is really the big difference between FHA and conventional. Is PMI, because it can really make or break your mortgage payment, and can either make or break your loan.
Yeah. And really quick with the private mortgage insurance, how long, once you have already purchased your home, you've been in your home, you've built some equity within your home, how long do you need that private mortgage insurance? Is it until you reach a certain amount of equity that you can say, hey, I no longer need this private mortgage insurance? Or is it to the end of your loan that you need the private mortgage insurance for?
That is probably the best question, the best question of the day, because it is so important that people know that and realize this now, because it has changed.
Right.
It used to be that your FHA or mortgage insurance would be eliminated after a certain period of time.
Right.
Now on FHA mortgages, sorry guys, I apologize for that. My dogs.
It's all right.
Yeah, no worries. Nowadays, FHA mortgage insurance can never be eliminated. It will stay on your loan forever.
Wow.
At least until you either refinance it to a conventional mortgage. It's the only way you can ever get rid of your PMI on an FHA mortgage. Conventional mortgages will be eliminated. PMI will be eliminated once you reach that 80% loan to value or 20% down. So let's say you buy a conventional mortgage and you put down 5%. Once you reach that other 15%, which may take a year, 2 years, 3 years, however long it takes, that's when that PMI will fall off. Can fall off. Let's put that way. Yeah, great question.
I know that we were already into conventional loans, but just to go back to FHA, what is the FHA limit for the state of North Carolina?
Great question. Every county is going to be different because they do have what they call high cost counties or high cost areas. Typically, and I always have to look this up because they change it every year, and every year it has increased, which is very, very good. Well, if you ever want to know what the income limit is in your county, you can all Google it. I'm just going to type in FHA maximum loan limit, maximum loan amount. So the maximum loan limit in FHA counties are $356,362. Yeah. Now that's the loan amount, right? Yeah. Not necessarily it's the sales price. Right. So if you take that 356 divided by 3.5%, because that's the minimum down payment, you're looking at about 375. That's the maximum purchase price that you're looking at. If you could purchase higher than that, the borrowers just need to bring more money to get down to 56. Yeah. But it's going to vary based off of county. Yeah. That's good question.
Well, I know that you're licensed in other states. What are the other states besides North Carolina are you also licensed in as well?
So pretty much the Southeast. So North Carolina, South Carolina, Georgia, Tennessee, Virginia, Florida. Oh, wow. And then I have Louisiana, a little bit out west. I have Texas, I have Colorado, I have Arizona, I have Nevada. I think I just picked up a new one. I already said Virginia. I think I had a loan in New York or something. I had to pick up that one for too. So, but yes, those are the licenses that I have. In general, like all of those are going to be different. So for example, down in Florida, that their maximum, I think it's like 412. Yeah. South Carolina, I think it's 356 as well. But Texas is bigger, so it varies everywhere.
Yeah. And Texas is like, the houses there are just amazing. They're less expensive and they're more big. Because everything big is in Texas. But what would you say, like from a mortgage specialist perspective, what would you say would be like the best place to live right now, or to buy a home right now, rather?
That's funny.
All the places you're licensed in.
See, now that's that's a hard question. You're gonna get me in trouble.
Like, which state would give you more bang for your buck, as far as from a mortgage perspective, from a purchase perspective, and also from a just a overall all around living perspective? What would you say?
Just be honest. I mean, I really try not to be biased, right? I try not to say biased, but I'm gonna stick with North Carolina, just because, it's just maybe the North Carolina South Carolina combo, right? I think that the people got it right. The people who maybe live in South Carolina and work in North Carolina, just because of, number one, North Carolina or Charlotte in general is becoming the new banking hub, right? There are, BB&T and SunTrust, their merger, Truist, is their headquarters is here. You have your, I think your Wells Fargo headquarters is here. Lowe's headquarters is here. It's a lot growing in Charlotte. A lot of people moving from New York, New Jersey, Ohio. We've seen it, right? Which is obviously doing wonders for our value, right? The people who purchased houses are seeing are reaping the benefits of the equity growing in their houses. I have seen it's not uncommon for somebody to have lived in their house for 3 years and have gained $80,000 to $100,000 in equity just in that fast, right? In South Carolina, property taxes are less expensive in South Carolina. Gas is less expensive in South Carolina. School systems are a little bit, as far as, Mecklenburg County, it's not the best. We do have Cabarrus right next to it, but, depending upon if you have kids or not, I'd say, North Carolina, South Carolina has the best combination of, good weather, the mountains and the beach, nice people, your property values rising, businesses are growing. Our economy is booming, right? North Carolina's economy is booming. Can't say the same for everywhere else, but you see, Georgia, I think is good too.
Yeah.
But I would stick with North Carolina, honestly, just out of what I hear from other places. Florida's a mess. Florida's that's just all personal preference,
we actually
from a mortgage standpoint, I would say North Carolina, just from what I've seen in values increase. North Carolina is one of the hardest hit states, so they're coming back.
They're coming back. They're making a comeback.
They're coming back pretty good.
Yeah.
Their values have increased very substantially. So, and South Carolina as well, just because they're getting the overflow from the people who can't live in North Carolina.
Yeah. And other Northerners are moving here as well. But I'm going to open up the chat for any questions. I have someone in the chat writing a question now. I'm going to let her ask her question. I think it's one of my good girlfriends, Angelique. I'm going to unmute you, Angelique, so you can ask a question. And anyone else that wants to ask a question. Are you in? There you go.
Yeah, I am. Good afternoon. Can you hear me?
Yes. How are you?
Hi, Jen. I'm doing great. How are you?
I'm doing wonderful. Thanks for asking.
Right, cool. So yeah, I put 2 questions in there, but the incentives that you're talking about, it's only if you're a current resident, right? If you live in North Carolina in that state.
What incentives are you referring to?
I mean, you're saying the low interest rates is booming, the economy's good, but for someone that lives out of state, would it be, I don't know if I'm asking the wrong question.
No, so I think.
Let me rephrase. I live in Orlando. I know all the down payment assistance grants. I know all the incentives that they're offering. But if I don't live in North Carolina, is it beneficial for me to try to leave here to go somewhere else? For my first?
Yeah, well, no, I mean, honestly, it all just, right? Because I know that I do business in Florida too. And like you said, there are a lot of assistance programs in Florida. And all that good stuff. The interest rates are not tied to North Carolina, right? Those interests, you're going to get the same interest in North Carolina that you would in Florida. Same with the down payment assistance and things like that. It's really, like I was saying, it's really just a preference type of thing. For me, what's important to me, I like, living in North Carolina because of the mountains and the beach. For me personally, I sweat like it's nobody's business. So Florida
Hot.
My sister lived in Tampa. Tampa was cool because it was, they got a little bit of the breeze, but Florida's gorgeous. Love it. I love to travel there. It's just, it was a little too hot. But I guess to answer your question, those incentives, yes, those incentives don't necessarily pertain to North Carolina. They are available in every state. It's just a matter of what's important to you and where your job will allow you to go if you work remote or if you want to move to North Carolina, right? If that makes sense.
Yeah.
But we are seeing more people that, that are working remote. They want to choose to live anywhere. I see a lot of people moving to Texas. You see a lot of people because of COVID. It's funny, because of COVID, a lot of people move to those freer states, right? Like Idaho, Utah,
Mhm.
and North Carolina and South Carolina is starting to become a little bit of that as well. As well, you're probably down in Florida, seeing that a lot. People want to live in Florida now because they're not going crazy with a lot of the laws and the rules that people are putting in place because of COVID.
Yeah, absolutely. Absolutely. Does anyone else have any questions? You have more questions, Angelique, for Jeremy?
I was gonna see if anyone else wanted to go. Earlier, I asked, I don't know, are you familiar working with like 504 loans? I do have a business. It is literally a remote work from home platform that I've had for years. So, in looking at getting funding, I bank with Truist, who is now SunTrust and B. I
Yeah.
don't know if you hear people cutting grass. I'm sorry,
Yeah,
but
no, you're fine. You're
hold
fine.
on, I have a noise canceling headset. Oh yeah, that's I mean it sounds easy and simple, but nothing is that simple.
Sure.
Does it make sense? My main platform was Carnival and they'd shut down due to COVID. So the income I need to wait till I build up 3 months of like equity or what is it? Having your money
Reserves.
seasoned in the account.
Yeah.
So I'm
Yeah,
looking
3
into
months of
using
reserves.
funding from the SBA, the EIDL.
Okay.
They're offering funding, so I requested an increase. And I'm
Nice.
wanting to use that increase towards a deposit towards my first mortgage. So it's a matter of keeping my work from home business in alignment, so I qualify, and then multi-use to guarantee that I can pay that loan back. I want to do a multi-family unit.
Yeah. Yeah, and yes, to answer your question, you can absolutely do that. And I've had other people have used the SBA loans for their business as their down payment. Usually, when you do that, let me ask you: do you do your own books, or do you have
Hold on,
like
'cause
QuickBooks?
I don't know if y'all hearing that lawnmower. So
Oh, I can't hear it at all.
Oh, you
You're coming
don't?
through crystal clear. No,
Karen,
I
do you
can't.
hear it?
Yeah,
No.
Okay,
I
I'm
can't hear
sorry.
it at all.
Okay,
Yeah,
so
we're fine.
ask me that question again.
I was asking, do you do your own books like through QuickBooks, or do you have
I
like?
did. I hired a CPA because in addition to having my own business, initially I was the only one in the platform, but because of the pandemic, people were more interested in working from home.
Sure.
Yeah. So I had agents come and go this year. Okay. So in rebuilding, I lost the question again. I'm sorry.
No, you're fine. No, you answered my question. The reason I asked it was because usually whenever it is fine to use the SBA loans as down payment for the next home purchase. Right. The two things that they will require: number one, they'll want like a letter from your CPA saying that using the funds from your business is not going to essentially shut down your business.
Correct. It's a work from home platform. So that's why
exactly.
I've been trying to get a mortgage with the best down payment forever right now in Florida. Like I said, your depth of income is important. My credit, I kind of study credit. I offer to help people build credit, but
nice.
you have to have that income coming in to prove that you can pay it back. So
now do you have, now let me ask you.
I have a business plan and I have the website. I didn't want to start shooting stuff in here.
No, you're fine. No, you're fine. Do you already have the business up and running? Like, is your business already up? When did you start?
2018 was when it was established here in Florida.
All right.
I started in 2013, but this one, they got dissolved and I redid it. So yeah,
I got you. Are you showing income on your tax returns?
Huh?
Are you showing income on your tax returns?
Absolutely. Yeah.
Are they just, okay,
So this next year's tax return is gonna show more. It's gonna show the employees that work
Yeah.
for me all year. So
okay,
I believe in timing. I don't know when my timing is, but I know
Sure.
I'm putting all my
Yeah.
ducks in a row.
yeah, well, no worries. I mean, yeah, if you have your tax return, that'll be able to determine like, how much
You
that's
can afford.
dictate how much you can afford. And as long as your credit score is there, you can afford the payment. I don't see why that would have stopped you from being able, even with the down payment assistance, you can still get that and still qualify. What type of banks were you going through?
Right now I only bank with BB&T, who's now
Is that who
Truist.
you tried to do the purchase through, or tried to?
I talked to the branch manager, like she gives me advice on what to do, where to go. So the last thing she told me was get the business plan done. So
Yeah.
I've worked on that for like 6 months. I still don't feel like it's complete because I keep modifying it to make sure it looks fundable. Like,
So my question is, I'm sorry, I didn't mean to cut you off. Well, my question is, why does she want you to get a business plan if you already have the business up and running and you've been generating income and it's tax returns for the past 2 years? What do you need a business plan for? I'm just asking.
well, to present how I'm gonna use the funding to do the profit and loss, to show
Oh,
the
I
3
see.
years, to
So
show that it's not gonna lose
I
money.
see. So they need that. Do they need that to get the loan for the mortgage, or do they need that to get like the down payment assistance?
Okay, so no, you don't need that for down payment. I don't want to make this like a one-on-one because I know other people.
Sure,
that
yeah,
need
no
it, so
worries.
we should definitely
right.
follow up. But the thing is me. I've been
Yeah.
looking at all the different options and I just want the best option. So
Yeah.
I pre-qual about 3 times and then I know what I
Oh,
need
I
to do
see.
on my end.
I
Yeah,
got
but
you.
I've never
Oh,
actually
okay, I see. So it's not the issue
submitted
of getting pre-qual. Okay, I said
yeah, my income's been fluctuating so much that I'm like, I'm gonna wait
understand.
till I can have it
I
back
understand.
consistent again
I understand. I
with their income
misunderstood.
and mine.
I thought you were saying that nobody was able to get you approved. So I misunderstood. I thought that's what you were
Yeah,
saying.
no.
Okay, did I answer your question?
I mean, I want to know if you can help with this. Like, what is
Yeah,
that something you
absolutely.
specialize in?
Yeah, I can help. Yeah, I'm licensed in Florida. I can do
Gonna
that.
have to book
Yeah,
a
100%.
appointment.
Making
Yeah, no problem.
connections here. This was the purpose.
Yeah.
I wanted to know, like, if anyone has any questions. My aunt is on here too. I want to know if she has any questions. Aunt Sandra, do you have any questions?
I just wanted to know the website he was talking about where you could put your address in for like the USDA, I mean, or whatever that loan is for the rural part.
Yeah, let me pull it up real quick and I can type it in the second. Eligibility.
Oh, man, I'm in Georgia now.
You know what I was thinking, when I was like, what's some of the states? And when he said VA, I thought about you. So you're in Georgia. He's licensed in Georgia as well.
I just put that.
Yeah, but he can't help me with what I want to do. So
He's very resourceful. Jeremy's very, very resourceful.
I mean, he's a wealth of information, but I we'll talk.
Okay. Do you guys have any questions for Jeremy?
I just put that link in there for you, ma'am.
Oh, okay, great. Because I said now that I'm here in Georgia, that's something, because there is a lot of rural parts.
Oh yeah, absolutely, 100%.
Well, let me take a screenshot of that because that's a lot.
Yeah, sorry.
You're right. I was going to write it down, but I'll screenshot it.
Yeah, no worries.
So Jeremy,
Awesome.
do you have any final thoughts or advice that you want to just drop for anyone?
Well, I would say the same thing that you said. What was it? Know before you go or know before you sign.
Yeah.
Whatever you guys do, talk to somebody about it. Right, the mortgage process, it's so big. Right, the mortgage industry is so large. There's so many things that you can do. You want to make sure that you are, number one, understanding your loan program, and number two, getting the loan program that fits what you're trying to accomplish, right? because of the different things that we can do, a lot of loans can almost be tailor-made, right, to fit somebody's situation or personality or whatever that looks like. So when you're applying, a lot of people think that it's still the old days where you walk into the bank and the bank tells you what you qualify for. While that is still kind of the case, you do have more of a say. It's more of a, hey, what would you like? What kind of features do you want in your loan? Like, what's important to you, so that we can make sure that we get the best loan together for you. I would say because those things are possible now, it's even more important to make sure that you're dealing with somebody who knows what they're talking about. You don't want to find yourself in a bad loan. You don't want to find yourself in a situation where you wish you would have known something sooner, right? So all that to say, people take their mortgages seriously, as they should. So remember, take your mortgage seriously. Make sure that you have somebody who knows what they're doing, who can communicate it to you well. If you're not the expert, make sure that they are the expert. You want to have the right people on your team. That's for sure.
And real quick, Jeremy, go ahead and drop your, give everyone your email and your phone number for people that want to contact you for anything.
Yeah, no worries. I'm gonna put it in the chat. But just verbally, again, my name is Jeremy Smith. My phone number is 919-604-7084. My email address is just jeremy.smith@LHFS Larry Hugo Fox Sam.com.
Thank you so much, Jeremy. And I thank everyone for
of course. Thank you guys for having me.
Yes,
I appreciate your time and letting me be a part of the call. If you guys ever need anything from me, feel free to reach out. If you guys ever need any resources, I know a lot of people. I've been doing this for a long time. So anything real estate related, I probably know a guy.
Thank you so much, guys. It's been great. Q&A Wednesday, every Wednesday. I have a guest speaker who comes on here and talks about credit, mortgage loans, commercial, residential. So I want to keep this going every Wednesday. If you guys have a topic that you guys want to do, or you guys want to come on here, bring your own business ideas, I would love it. But I appreciate everyone coming out and joining my Zoom today. You guys have a happy Thanksgiving.
Yes,
and everyone's time. You guys enjoy.
Yes, happy Thanksgiving.
Thank you.
Bye-bye, guys.
Yes.
Happy holidays, everyone. Thank you, both.